This episode is brought to you by Plaid. Plaid helps lenders approve more creditworthy borrowers without taking on more risk, combining real-time cash flow data with behavioral insights. It's a fast, familiar experience people trust and that actually converts. Learn more at plaid.com/FTT. Hello, and welcome back to the Fintech Takes podcast. Today, we have another edition of Not Fintech Investment Advice with the great Simon Taylor. Simon and I were actually just together at an event, the Fintech Exchange event in Utah, and we recorded this not in the same room, but at least in the same time zone. And I think you'll be able to tell because we were very much in sync for today's episode. As we always do, we talked about 4 different fintech companies that had caught our eye. We picked a pretty wide variety. We bounced around prediction markets. We talked about things happening in crypto that make me actually kind of optimistic, which is not totally the reaction I have when I look at crypto stuff, but is changing a little bit. We talked about kind of the changing path to wealth and wealth management and how that needs to evolve. And we ended with a very philosophical discussion about building products and rebelling against this sort of moment that we have of financial nihilism and gambling and everyone just being depressed about the future. So even though at times it got a little dark, we also ended, I think, in a very optimistic and hopeful place. And as always with Simon, I uncovered a lot of different ideas about how I think about this stuff in conversation with him. So I hope you enjoyed today's episode. We also got a chance to chat very briefly about Simon's event coming up at the end of this year, FinTech NerdCon. You've heard me talk about it before. I got a chance to go last year in Miami. This year in November, it's going to be held in San Diego, which I view as a big upgrade. And so Simon gives some details on the show as well. As always, thank you for listening, and I hope you enjoy another edition of Not Fintech Investment Advice. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Simon Taylor, how are you, sir?
Alex Johnson, I am extremely well, my friend. It was good to see you just yesterday as we record this. How are you? You get home safe?
I did. Yes. Safe and sound. I hope that you have a good travel experience home as well. You have a lot further to go than I do. Simon and I were both very pleased, I think I can speak for you, to say that we got a chance to speak on stage together at the FinTech Exchange Conference in Salt Lake, put on by our friends at the University of Utah. I don't know, Simon, always one of my favorite events. It's a little on the smaller side. It's very high signal to noise ratio, lots of great folks, a good mix of our favorite people who we see all the time, also mixed together with, I had a lot of fun experiences talking to folks who I maybe had corresponded with via email or over social media, but had never got a chance to meet in person. So it was a good event. How did you enjoy it?
Same thing. Lots of just small, tight-knit group of people and bumping into them and having longer form conversations, whether it's a startup, bumped into the guys from Velocity, whether it's the banks, the new CEO of the Mercury Bank based in Utah. Utah has, of course, the ILC banks. It secretly sort of powers a lot of financial infrastructure. And once you see that, you can't unsee it. It's like a little mafia, very tight-knit group, but very helpful. And if you're a fintech nerd, this is one of those tight-knit groups that you want to be a part of. So really enjoyed it. Yeah.
No, that is absolutely true. Yeah, especially in the age of charter everywhere, there was definitely a lot of great conversations in the room about just the flood of different types of bank charters, national ones, Utah-based ILCs. But yeah, the number of executives who live in Salt Lake who, when someone wants to start a bank and they want to have an adult in the room with them, they recruit from Utah is actually fascinating. There were quite a few. There were multiple people I met who were like, yeah, I was working at a bank, but then this fintech company wanted to be a bank. And so now I'm on the board of this fintech company. That happened multiple times. And so it is a strange epicenter for not only fintech generally and for open banking and other things that we've talked about a lot over the years, but particularly in this moment for charters, I was surprised how central Utah is to that discussion.
So many of the charters are domiciled in Utah, or they're headquartered there through the state, but also then nationally, and they build the office here. And so if we're looking at lots of companies becoming banks, then the place to look at is Utah. And you can be on the ground with the people, learning about what they're doing. And I find it so fascinating that we're probably going to have 10 to 20 new FDIC insured banks and maybe hundreds of new chartered banks overall with the national trusts. This is going to really change the market in a way that I don't think it's been changed in a very, very long time. And so some of the insights about the way they're staffing up and how they're staffing up, it's really, really interesting where they're at with the OCC and the regulators, what their process looks like. So real education, and good to see people taking it really, really seriously, trying to do it as the adults in the room, trying to build it out and do the right thing by customers. So long may that continue.
Yeah, that was definitely a theme, was like the seriousness with which people seem to be approaching this project, which I thought was great. And it is a good point, right? I mean, the charter situation, it's a huge reversal. I mean, we spent a decade plus just like with the number of banks just going precipitously down. And I talk about it as like the birth rate and the death rate of banks, right? Like banks are always going to appear, they're always going to disappear. Like there's just a natural rate there. But the birth rate was artificially low of new banks in the U.S. and that has spiked up. And now we have a lot more new banks. We have more new de novo credit unions, and so there's a surge in that activity, and the long-term implications of that will be fascinating. Simon, I also wanted to give you a chance. Salt Lake City, lovely place to visit. San Diego, also a lovely place to visit. Maybe like right before Thanksgiving, the fall, when the weather is kind of starting to get not so good, but you want a little bit more sunshine before Christmas. I'm just spitballing here.
Yeah, no, it's a crazy idea, Alex, but I think I'm going to go with it.
Okay.
So San Diego, beautiful city, home of Anchorman the movie, and now home of FinTech NerdCon. We're doing the second difficult second album time. We launched ticket sales just a couple of days ago, and we're doing the same sort of thing. So, no more than like 1,000 fintech operators. But the feedback from last year was the reason you go here is because of the people in the room. You are going to bump into somebody you don't know who's your new industry bestie. You're going to find that next great hire. You're going to have conversations that make it well worth your trip, and you'll be somewhere sunny in November. So we're super excited to take the wraps off it. And fintechnerdcon.com, tickets are available now because I think they're going to sell out. We sold out last year, so don't miss out on the second one. If you had FOMO, come get involved. I know, Alex, you're going to be there. We're going to do lots of interesting stuff, and it'll be a lot of fun. So thank you for supporting, my friend. I appreciate you.
Of course. No, I'm excited to see version 2. It's the second album thing is funny. I do think events, and you and Colton probably had, in fact, I know for a fact you had just like days of download on like things you learned putting on an event afterwards. Events is one of those things where you learn a lot every time you do it. And you learn, I think, unexpected things. And the thing that's cool to me, and it's interesting timing, I think, right now, just with like the state of events and financial services overall, that kind of feels like a moment of change. But all of these new events, and NerdCon last year was a great example of this, they all have these very distinct like feels and kind of culture and character that is very, very different than the standard like everyone just goes to the same conference and it feels exactly the same every year. We're in a moment of like, if you're looking for kind of like a new tribe or a new little corner of the ecosystem, there's probably an event forming there. And so would highly recommend folks check out NerdCon, get involved as speakers, sponsors, attendees. It's going to be a lot of fun.
Thank you, sir. Appreciate it. fintechnerdcon.com. Come hang out. We'll be talking about some not fintech investment advice today, and we'll be mentioning lots of interesting companies. I cover 4 fintech companies every week in Fintech Brain Food, and I make sure that some of those most interesting founders and teams come down to the show. So if you like this show, you'll probably like that too.
I think that's absolutely true. And that is a wonderful segue, Simon, to the game that we play on this podcast, which is picking fintech companies. Since you are still like in Salt Lake and, you're going to be getting on a plane soon, I'm going to give you the honor of going first. What's the first fintech company you want to share?
All right, I know how much you love this category, so I wanted to bring up a sort of a prediction market company for you, Alex.
Okay.
And it's not the one I mentioned on stage the other day, which was interesting, but this is a company called Kairos, Kairos. They are a multi-prediction market trading platform. So they provide a single terminal and dashboard for traders who want to buy and sell events contracts across Kalshi and Polymarket and all of the new ones that are popping up all of a sudden. And their goal is to bring together the real-time data and analytics with low latency execution in a single place. And this team's ex-SIBO, they're quants. They worked on ML engineering at NASA. So yeah, like this is a heck of a team. And you know, when you see something and you go, that seems obvious. Why did nobody do that already?
Sure.
That's usually a sign that it's going to do quite well. And Alex, honestly, as much as I share your fear and heartburn around prediction markets in general, being ultra targeted at consumers and sort of trying to legalize gambling and financial nihilism, this is very clearly targeted at a pro trader who operates across multiple venues, probably not suitable for retail. And if this is ever going to become a capital markets product, we're going to need things like this and teams like it. I still don't think it fixes the fact that a lot of where the market signal and the alpha for these pro traders is going to come from is consumers who are taking a punt. Like that seems sort of predatory. But long may we focus on the institutional stuff. And I think there's a real gap in the market for people with that experience to come into prediction markets generally. This is a trend that is not going away. Like the genie is out of the bottle. Polymarket opened a freaking supermarket and store in New York with free groceries. Like what? So that's not going away anytime soon. Maybe we can professionalize this. Maybe we can do something along those lines. And maybe this team seems like a really good one to do it. So what say you, Alex?
So I'm going to be fair, Simon, because I'm nothing if not fair. You know that about me. I will say that, like, I actually don't mind certain components of prediction markets. I think they're interesting. I think the whole idea of like creating sort of price-driven certainty around sort of observable events in the world is interesting and smart and potentially very socially useful. Like my heartburn with this stuff comes with, as you were saying, retail, sports betting, stuff that doesn't have any like broader social utility. It's just gambling. But this is obviously, as you said, clearly not focused on that. They describe, I'm looking at their website, they describe that they exist to close this gap that exists in sort of the infrastructure of prediction markets. They say what the Bloomberg terminal did for Wall Street, Kairos does for prediction market traders. I think that's like a very valid sort of approach to kind of building better tools for those traders. So that all makes total sense to me. I do, I guess, share your heartburn still that like the other side of the trade here is still like dumb retail, and that like fundamentally still seems like a challenge. Now I will say, like, you know, there's kind of a question with prediction markets, I guess, of the types of contracts, right? Matt Levine was writing about this in Bloomberg, where he was saying that, like, you know, there's different ways to make money in markets, right? And one of them is, hey, if I want to take a long-term position on something, just from like more of like a wealth building diversification perspective, but the liquidity I provide into that market can then be arbed a bunch in the shorter term by more volatile traders looking for risk and looking for return. But fundamentally, it doesn't like affect my long-term outcome. Like that can be kind of a win-win situation in a sense. And so I'll be curious to see how prediction markets evolve, because at the moment, it still feels like they're very much oriented around like short-term bets, like really quick turn, like liquidity. Like it doesn't seem like a venue for sort of stable long-term positions. But if they evolve into that way, I could see a scenario where you have like retail participation in prediction markets, maybe mediated through like intermediaries that are building like, it seems absurd to say this right now, but like an ETF of prediction market positions that is sort of like a good long-term way of thinking about diversifying risk in the future. You can imagine something like that kind of insulates retail from like short-term volatility and gambling. And on the other side, you have traders using Kairos to do research and find short-term arbitrage opportunities. So like if you squint, you can sort of see this evolving the same way that the stock market did, where there's a way to engage in the stock market as a retail investor where you get destroyed, and we see that all the time. But there's also a way to engage in it where you get good long-term outcomes, and it still creates a game for others to play if they want to take risk and potentially generate alpha. So I think that would be my most optimistic spin on how this could be a part of an evolution that ultimately is like a net positive. Does that make sense?
Yeah. And my sense is, Alex, that if you look at history, you see that markets evolve this way consistently. That when commodities and futures were first introduced in the sort of early part of the 20th century, the initial reaction from the mainstream media, from most of society, was this is disgusting, it's gambling. And it's sort of around the time of Prohibition generally. And it was not liked because you were gambling on the price of corn. This is clearly not something that's useful. Now, with the benefit of hindsight, once a market has enough liquidity, you can see that, no, and we get the SEC is set up, and we sort of make sure that retail's not necessarily punting on that stuff, and you build in some consumer protections, and these things wax and wane. The democratization of access to some of that is sure, but do I really want to democratize access to some stuff that's really, really ultra dangerous? And do I want to be thoughtful about how I do it? That is not a badge of honor necessarily if you're not thoughtful about how you've done it. Do I want to give people exposure to the available upside that come from these markets and futures, like private credit as well and private equity? Yes. But let's just be thoughtful about how we do it. And I think that will come in time. And I think two things will happen. Liquidity will mature the markets. And if I speak to people who are deep in prediction markets, they'll go, look, we know the sports betting stuff it's a bit ugly. But it's liquidity. And if that's what bootstraps the flywheel, okay. And consumer protections, hear you. They will come in time. Already good thoughts going on in many places from what that needs to look like.
Sure.
But they're also just trying to keep the lights on and just deal with the fact that the thing's kind of exploding. I still, in my heart, think, sure, but if it were me, I'd still be building the consumer protections anyway. I just want to be able to look myself in the mirror when all of this does go bang. But still, people are rational actors. They'll do what they do. But if you add the liquidity to the fact that there's probably going to be a societal reaction at some point, regulation is what happens when something must be done. There's going to be a blow up. There's going to be a disaster. There will probably be some counter narrative or reaction at some point. And both of those things should mature the industry. I just don't like the fact that that's the way humanity seems to work in finance. And, we can sort of see this coming, and why can't we make it better? But Kairos is, to my mind, when I'm looking for hope in prediction markets, financial nihilism, PvP, PvE type of mentalities, this is the kind of thing that gives me hope, because there's light at the end of the tunnel, and can we just build towards it?
Yeah, I think that's totally fair. I mean, for me personally, I don't think adding sports betting here as the cost of getting more liquidity into the market is a price worth paying. That's my personal opinion. I understand the argument for it. And obviously, these are businesses and they're going to take advantage of the opportunities that are available to them, right? I mean, I think, the honest answer is the CFTC is the one who's fucked this up, right? The market's going to do what they're allowed to do. And it's the CFTC allowing this that is the part that is screwed up that I don't like. And I think, I actually look forward to a day when I can calm down about prediction markets and find them interesting and not infuriating. And that day will happen when the CFTC under probably a future administration goes, look, this is sports betting. You can't use prediction markets and commodities for sports betting. We're not going to allow that. But if you want to do other things that have social utility and you can manage, Kalshi's come out and really talked lately about insider trading and cracking down on insider trading. Like, if you can solve those problems and keep it away from sports, which again has no social utility, great, go for it. And I actually think that at that moment, I will be interested and not infuriated for the most part by prediction markets. And that's where like this infrastructure coming in makes sense, right? I mean, to round out this discussion with one quick example, I can't remember which of the two prediction markets it was. They move in like such close tandem these days. Like the grocery store thing, like one opens a grocery store, the other pays for New Yorker's groceries the same day. Like they're like really in this like sort of mirror contest with each other right now. One of them partnered with a real estate like pricing company, and the idea is to be able to bet to wager on the price of housing in different markets. And that one was interesting to me because, again, there's a way to frame that as gambling, which I think is largely what's happening right now. But you could see that as a primitive getting built into a different type of experience that could be presented to a consumer as a way to hedge like housing market risk, right? And no one does that today because the primitives are not combined
insurance.
in the right way. Yeah, but like the idea that you could make that a component of an intelligent strategy for hedging risk, that like the primitive makes sense. The problem I have is the way that it's packaged and presented. And so if we can like grow prediction markets to a thing where it becomes a useful primitive for more responsible actors to package into products for risk management, I am great with that. And if Kairos can be a part of that future and that solution, love it. I'm just waiting for the day when we like acknowledge what we all know to be true, which is that sports betting has no place in any of this, and we kick that out. And I actually think we will get there at some point, to your point, like the consumer protection stuff always catches up, sometimes violently, with these markets.
100%, man. All right. Well, that was enough prediction markets for one day. What have you got for me, sir?
You'll be surprised I don't have any prediction market ones to bring. So we'll end the prediction market conversation there. I do have some Simon-y type companies, though, and I think you'll find these interesting. So the first one is one called Vault. And they are doing basically crypto-collateralized lending. But there's a huge distinction here that I think is really important and interesting, which is most of the time when you say sort of crypto-collateralized lending, you are talking about over-collateralized loans used to get leverage to buy more of the assets that you are pledging as collateral, right? So that is the most common strategy for crypto-based lending. That is what powers a lot of the like DeFi yield type products. Like that's the sort of model in crypto lending right now. Vault has a very, very different perspective on this, which is that separate from all the crypto speculative trading stuff, a lot of people just own crypto, right? Simon, I'm going to go out on a limb and guess you might own a little crypto. I own some. And their sort of premise is that a large number of people and a growing number of people are just going to own crypto as kind of just an asset among the many assets that they own. The opportunity afforded by that is that crypto is a very easy type of asset to, as you like to talk about all the time, Simon, wrap sort of programmability around and wrap conditions around and be able to take custody of and be able to liquidate. Like it's just a very like sort of programmable asset relative to other things that are annoying, right? I mean, classic examples are things like if you want to get a loan, you can pledge as collateral all kinds of stuff, right? You can pledge like your furnace in your house, right? I mean, you can do car title loans. There's all kinds of different ways that you can use collateral to unlock access to lending. But the problem is most of those types of collateral like exist in the human world, or maybe they're like stocks that you own, but there's really like a lot of challenges around doing that if you're not Fidelity. So the idea is crypto can be a very useful and very like easily manipulated asset for collateral-based lending. The challenge is banks who do a lot of lending have no ability to do any of this, right? And so if they are evaluating someone for a loan and that person owns crypto and them pledging some of their crypto could buy down the rate of the loan that they have or get them access to loans that they might not otherwise get, the bank might actually be very interested in doing that and view that as a safe thing to do, but they have no ability to like take custody of that crypto asset as a part of the collateral process, monitor the value of it. Like all of the infrastructure is missing there. And so what Vault is building is basically the infrastructure to allow for under collateralized loans using crypto as a way to enable like either better pricing or more access for other categories of loans that banks and other lenders not in the crypto ecosystem might want to do. So I thought this was fascinating because it was one of the first times, like I have an immediate allergic reaction whenever I hear crypto-based lending because I just don't like the kind of attachment to speculation. But crypto as an asset that a lot of just ordinary people own that they might want to use in the capacity of like getting access to loans or getting better pricing, that makes sense to me. And the fact that like banks themselves won't be able to figure out what that infrastructure should be because this is not their world, that also makes sense to me. What do you think about this? This episode is brought to you by Plaid. Approving more borrowers shouldn't mean blindly taking on more risk or adding more friction. The problem is that traditional credit data is limited, and cash flow data alone doesn't always tell the whole story. Plaid helps lenders see the full picture by combining real-time cash flow data with insights from the financial tools people already use every day. Those signals come back in seconds through a low-friction experience trusted by about half of US adults. That means you can approve borrowers who are stronger than their credit file suggests, spot risk earlier, and grow without loosening your standards. Learn more at plaid.com/FTT.
Really great find. I'm surprised I hadn't seen this one. So
I'm
I like it
surprised
a
too.
lot.
I'm happy to bring this to you, Simon.
No, so I have seen examples of people doing stuff further upstream where maybe you're offering a credit card product and you have a forward flow agreement with a private credit fund. So you originate the credit and then you draw down on a pool of cash from your private credit fund. And that typically is very manual and very paper-based and really painful for everybody involved and expensive. With crypto, you can originate the loan on the front end and use a smart contract to then draw that directly from the source of funding out to the consumer. So that straight through process goes from like fund to originator to consumer or business in that case. So that's kind of more on the institutional side. And there's a few companies doing that now. There's Fence Finance, there's Credit Co-op. But I hadn't seen anybody doing it to banks directly. What I have seen is Morpho. They do the classic type of vault, which is you pledge your crypto and you can borrow against it, or you can simply provide your crypto and earn a yield. And that's where a lot of the yield-bearing sort of products in crypto come from. This is a third thing, which is we're just doing the collateral piece.
Yeah,
we will give you the collateral. You then, as a lender, get to decide how you want to lend it. And as a financial institution, this is just collateral. You can figure out how to price it. We can help you recommend it. But this is just going to park the collateral there. And what's really, really nice, as you say, is just like the example I gave before, the paperwork on title, the paperwork on collateral, going and finding the furnace and taking a photo of it and proving ownership of it, that's where all the difficulty is. Being able to just have this thing where it's like, boom, there it is. And you've got this audit trail that's absolutely perfect for where is that collateral? It's there. I can see it. What's its price? It's there and it's available in the market. You start to rapidly reduce the costs. And as you say, a lot of consumers out there with this stuff. Market's in a little bit of a meltdown right now.
I know.
But even if you discount the value of the collateral by 50%, 70%, it's still useful. And a lot of consumers, what is it, like 50% of consumers have some crypto, 25% have $10,000 or more. That's meaningful. That's really meaningful. So if that creates credit And you tend to find that collateralized lending to consumers in particular is the type of lending where the lower income populations really, really benefit. Lower income populations also tend to have crypto. So I think there's a genuine case that can be made for expanding who gets access to credit here as well.
Yeah, I think that's right. I mean, it's funny. Collateralized lending is really interesting and always a challenging topic to kind of parse out, right? Because the questions you need to ask are things like, well, why are you borrowing money? What collateral are you using, right? And I'll be honest with you, I get the teeniest, tiniest bit of heartburn on all of the like home equity stuff that's getting built right now. And not that I don't like it, right? Like home equity, if you have it, is a way to reduce your cost of borrowing, and being able to tap into that more seamlessly is great. But one mild concern that you need to just be aware of is that's your house that you have to live in, right? And so like if you are borrowing against the equity in your home and you default and it gets to a situation where you end up having your collateral seized, like you have to live in your house. You don't have to live in your crypto, right? And so like having that liquidated or having that go away, obviously whenever you're doing collateralized lending, everyone's desire and obligation is to not have their collateral seized, but the consequences are, I think, much less worse when it's something like crypto than it is if it's like your house. And so I like it from that perspective. I also think the other interesting question that I'm just fascinated to see as these guys kind of scale up a little bit is, what does the credit performance look like, right? Because the other thing that you find is, in collateralized lending, when someone pledges someone as collateral, it does actually change the way they behave as a borrower, right? Like it adjusts in their own brain where this loan sits in the flow of like, if I had a credit crunch and I had to prioritize who to pay back, I don't want to lose like my crypto as an example. And so I might prioritize this higher. And so the theory in collateralized lending is it tends to outkick its coverage from a credit performance perspective a little bit. And I think that absolutely is a theory that makes sense when it's your house or your car. I'll be curious to see if it's true with crypto. And to your earlier point, obviously we're seeing a huge drawdown in crypto prices right now. There's a lot of different factors going into that, as you and I talked about when we were together in Utah. But I do think one of the other things that if we could see more of this would actually be nice is a lot of the challenge, I think, in crypto right now is there's so much leverage that when you unwind the leverage, prices really go down a lot faster than they otherwise would. And I like the idea of lending happening against crypto as collateral where it's not over-collateralized. It's not a leverage play to buy more crypto, because I think that introduces more volatility. This is the type of thing that would actually introduce like less volatility into the crypto ecosystem. And so again, I like the idea of this being a stable asset. The last thing I'll say about it is Fidelity has a huge business doing lending against stocks, right? Like that's a huge thing that they do. And what's interesting about it is they sort of own a large chunk of that market because they don't allow others to play nicely, right? So like if you're Fidelity, you make it really easy for yourself to introduce lending against stocks and other assets that your customers own. But if someone else was to come to Fidelity and say, hey, we'd like to do lending against customers' stock portfolios that they own, would you give us a feed into all of your data so that we could like build services on top of that? Fidelity is not incentivized to play nicely there, right? And obviously, as we've seen with open banking, you can't really count on regulation like leveling the playing field there anytime soon. But again, the nice thing about crypto is it's permissionless, it's decentralized. Like anyone can connect these things together. And so I also like the idea that it kind of knocks down barriers to collateralized lending that the people who hold the collateral otherwise might be incentivized to put in your way. Does that make sense?
Completely. And I think what you have here is an example of all of the things the crypto folks were sort of talking about, but never delivered. They gave you a casino instead.
Right.
And now the institutions have shown up and other entrepreneurs have shown up and they're trying to build things with utility. And that's a theme I'm seeing in my day job at Tempo, right? Like the institutions are not worried about the price of crypto. They're happy about the fact that this infrastructure is now at the point where it's mature enough that it's delivering tangible ROI for them. It's worth tokenizing some of these debt obligations, the collateral. We're starting to see the beginning of tokenized equities. The DTC and NASDAQ, they are announcing their entire plans to tokenize all of the stocks if you want to. So you will be in a position in 2 years' time where if you have a stock portfolio and you are the direct legal owner of it, there may be ways and platforms you can start to use those to pledge as collateral or to borrow against. And that is really, really interesting because it does, as you say, start to open up competition at the infrastructure level. As somebody who's self-described as the disappointed dad of crypto, it's nice to see that, like, this thing I believed in for the past decade and a half is starting to have actual utility. And whilst the crypto Twitter is just like in the trough of despair, I'm in a very different place. I'm like, oh God, finally, this kid has so much potential and it's finally starting to show off. So pay attention if you are in a financial institution and you do lending, because I think there's something here that you could seriously investigate. You've got the beginnings of regulatory clarity. And if we do get the Clarity Act passed anytime soon and people stop arguing about silly things like yield, then we'll be in a really good spot.
Yeah, I think that's exactly right. I love the analogy of like, your son is really disappointed because his best friend just said he doesn't want to be his best friend anymore. And you're like, oh yeah, that's really sad. But like secretly as a parent, you're thrilled because that kid was a bad kid and you're really happy that like they're not friends anymore. And you can see your son's life heading in a better direction because they've like broken up with each other. Like to a degree, I think that's what's happening right now, potentially with crypto pricing kind of going in one direction and crypto utility going in another direction. So I could not agree more. I'll join you on the disappointed dad who's now maybe slightly more optimistic. Simon, give me your second company.
Okay, so this one is called Vennre, and they do wealth creation for the high earners, not yet rich. They're based in Europe, and they provide private market funds to those consumers in real estate, credit, private equity, and venture capital. They've done about $1 billion of deals with a 62% return on equity, and it packages all of that in a simple mobile app. But here's the bit that I liked. With one-to-one financial coaches, and those coaches work with AI to try and make it sort of mobile first, and they're trying to build it out so that they can scale it. The other thing I noticed about this company is, because you've probably seen a few of these companies like appear and people trying to package these private credit funds together.
Sure.
They're registered in the UK and Saudi Arabia, and they are Sharia compliant. So this is targeted at a really, really interesting rising upper middle class coming out of the Middle East and North Africa. And that dual licensing structure gives it access to a growing diaspora that we just don't talk about in the West. That as more first and second generation British citizens of the Muslim faith are looking for Sharia compliant investments, they now have access. But they're also there's a whole swath of like migration from the sort of upper middle class in the UK and Europe more broadly to the Middle East, places like Saudi Arabia, places like Dubai, yes, for tax purposes, but also, frankly, for opportunity. There are more jobs there. There's a market that's really changing. And the signal for this is the middle class is sort of its center of gravity, and that part of the map is starting to move. But I always look at these products and think, like, why isn't that just in my brokerage app? Like, why can't I just buy these product funds elsewhere? Why is this so difficult to get access to? And I'm sure you've seen a few of these in the US market come and go. Have you seen it show up in your brokerage yet? Like, have you seen these types of funds being broadly available? Like, I would imagine if it was something that consumers wanted, Robinhood would have done 30 of these. So I'm struggling with I feel like I'd want this, but also if it's just an app by itself, I'll never use it. And is there an upper limit to the scale because they're having to buy funds on the back end and then turn it into fractions on the front end, and then it never really works. So what say you, Alex Johnson?
Yeah, it's interesting. I mean, I actually I interviewed one of the main product executives at SoFi yesterday at the FinTech Exchange conference, and we were kind of talking about this idea that like obviously SoFi has rebundled itself into like a very like massive, almost super app-esque, like full service digital banking provider, including a lot of different investment products. And we were kind of poking at the idea of like, well, how many different types of investment products should you offer, right? Like, is there a point at which you want to stop and go, yeah, we're going to offer this, but we're not going to offer this. Like, we're going to offer access to companies in their IPO window, but we're not going to offer access to private credit funds or whatever. Like where do you sort of draw that line? And what she said that I thought was really interesting was that their philosophy is very much like yes and, like the kind of old improv rule, like just yes and this also thing. And so they don't really think of it as we need to stop at one point. The trick is when you do yes and, you have to have a really strong layer over the top to help people navigate those different choices, right? And where I object to certain companies when they approach wealth management and democratizing access to these different assets is not so much the assets themselves, because it's all just like risk versus return, right? I mean, everything in life is just risk versus return. The challenge is how the thing is presented. And I guess this does take us back to our prediction market conversation a little bit, but like, Robinhood runs a casino. And so when it adds assets, it frames the thing it's adding as a game of chance played in a casino. And that's how it's presented to users, right? It's a little bit the difference between like, if you walk into Caesar's Palace and they offer, Yahtzee, like they're presenting it to you as a gambling thing, and it's going to draw in degenerates and it's going to be framed in a certain way. If I play Yahtzee with my family at home, we're playing a board game, right? Like it's the same game presented in two different contexts. And I think that a similar sort of dynamic is at play here where, I don't really mind them aggregating lots of these sort of non-traditional assets. To your point about the sort of changing face of the middle class, like I do think, and Frank Rotman talks about this when he talks about financial nihilism, like we do need to accept the fact that the underlying rules of the game have changed in a way, and that consumers' desire for access to these things, or even like moving from the UK to Saudi Arabia or whatever, like when consumers do these things, they are rationally responding to market forces that they see. And we should respect those changes and understand what they mean. And so I think, it's not bad that this behavior is happening. The layer I focus on a lot is, okay, how is this going to be presented? And maybe this goes as a question back to you. It sounds like it's a combination of sort of like AI and like human advisors. And, to me, that's really interesting because one thing I have seen in the States a lot is this question of like, how can we scale advice? And it's hard, right? Because like private wealth management, it scales because the person is insanely rich and can just pay for like a human to care about their finances full time all year round. When you scale it down, like humans are expensive. And so like, how do you make human wealth advice extensible? How can AI fill in the gaps there? At what point do you hand it off from AI to a human? Because ultimately humans oftentimes want advice from another human. Like, I think we're still in the very early ages of figuring out where with generative AI it can be extensible to humans giving advice, and then where it can replace humans giving advice. And like, I don't know where that line is right now, but it sounds like they're playing with that layer on top and kind of how to strike that balance.
Yeah, they are. It's just for these types of asset classes. It's just for private credit, just for private equity, just for real estate. And so will that get traction? And I sort of think with this demographic, maybe yes, because they're the type that would be thinking about this. Also, one thing I didn't mention that's really important is when people look to move and migrate from the UK or Europe to Dubai, to Saudi Arabia, they're often making a real estate purchase in order to get the visa. And they're moving their family there. And when you're buying into real estate, you're suddenly learning about the real estate market. And what these guys have done is they've started to work with a lot of those real estate companies as people are buying off plan, or people are buying sort of the new builds, to also introduce this like wealth building kind of app. It's like, if you're buying this, you might as well also buy into the kind of construction boom that's happening across the region at the moment. So I think that's fascinating. The other big one to me is like infrastructure. I've not seen a consumer infrastructure fund, and those are crushing right now in capital markets. The amount of data center build out going out right now, like what if every 401k gave me access to the amount of data centers being built? Suddenly I wouldn't mind necessarily all of those data centers in my backyard because I'm seeing a financial upside from it. Suddenly my energy costs going up a little bit are going to make me not necessarily so hated because this is doing really well. It's like there's just something, maybe I'm sort of bleeding into manifesting here, but like,
yeah,
I want to find ways to give consumers a way to share in the upside of financial markets, because the Gini coefficient just keeps running away from us. We keep seeing this power law that's getting worse and worse and worse, and you can see that in politics, and you can see that in sort of the disunity in the West generally, and the internal chaos that's kind of going on, and every incumbent sort of getting booted out at the next election. That's not good and it's not sustainable. But we in financial services can do something about that. Like we can get these products to these consumers. Like let's do it. It's not beyond the wit of man. And I think it's those that have the consumer distribution that are not doing this that could be doing it, because they're thinking about, how do I give you a credit builder? And that's kind of, okay, you got to stop the bleeding for somebody that's in trouble, right? You've got to deal with the first thing first, but give them the ladder too, and give them the ladder into things that are outside of the classic 60-40 portfolio and that sort of thing.
Yeah, no, I think you're right. I mean, I think, again, you just have to acknowledge that the path to wealth building has changed, and you need to find ways to safely package a wider variety of risks and make it available to consumers. And again, what I scream about all the time is the gamblification of that impulse. But the impulse itself is not wrong, right? And so I think that separating those two ideas is incredibly important. And I'm actually very excited for more sort of responsible product builders to sort of attack this problem, because I do think there is an opportunity there. I totally agree. Simon, I'm going to end with my second company, which is it's not even a company. It's like a product idea. You're the one who flagged this on Twitter, so it's your fault. I was very optimistic a second ago about all of the stuff that is getting built and, under collateralized crypto lending. And like, this is great. Simon, you introduced to me this crypto product, buy now, pay maybe.
Yeah.
And I'm mad now. It's your fault that I'm mad. But this is, you can correct me if I get any of this wrong. This is a sort of on-chain product, I guess, that's been built. And the premise is both funny and sort of existentially depressing, which is that you can essentially decide, you can bet on the odds of either getting something for free or paying more than what it costs. So buy now, pay maybe. The concept is that it gives you sort of a sliding scale in terms of what your odds are. And if you pay, let's say, double the cost of a product, so you pay double what it normally would cost, you have a 50% chance of getting it for free, or you have a 50% chance of paying double for it. And you gamble on basically the outcome of that based on, from what I can tell, just like random number generation. And you have the ability to slide the scale up or down so that like you can pay the regular price, the price that it costs, but you basically have 0% odds of getting it for free. Or you can max it all the way up to the most sort of risky, and you can pay way over. You can pay 100 times what it costs and have a 99% chance of getting it for free, or you might, end up paying 100 times what it costs. I think it's kind of a funny social experiment and representation of where we are in society and culture. But at the same time, like, I don't think this is totally being presented as a joke by the people who built it. It's kind of, there's this funny form of product building right now. The TBFN guys have talked about this, where it's like kind of the rage baiting as a product building strategy, where it's like, hey, I'm going to build this, and there's a 1% chance that it actually works and is interesting and takes off. There's like a 60% chance that it's going to piss people off and at least give me attention. And then there's like 40%. I just think it's like a funny joke and I want to add it to the internet discourse. And it depresses me that like there's smart people who spend their time working on stuff like this. What was your? You didn't seem super supportive of it when you posted about it on Twitter.
I wasn't, but I did see it mostly as performance art. Like,
that's what I thought.
Do you remember there was a card versus card thing in 2021.
I remember that. Yeah,
that was done by the art collective Mischief, and the idea there was every 24 hours there'd be a total amount put into a set of virtual cards, and whoever spent it all the fastest won. And it was just sending up consumerism. And there's a limited amount of these cards. They were obviously limiting the blast radius of it. They were sending up how easy it was to create a new fintech card program. I think this is sort of sending up buy now, pay later, gamification, gamblification. And I think it was intended as performance art, but it also, the art is pointing at something ugly.
Yes.
And that's why I didn't like it, is because the ugly truth is this is an effective product strategy. And there's going to have to be some sort of adverse reaction or response to it, because we are just living in some dystopian world where this is kind of common product design and it's seen as rational. And
it's hard. It's
because disappointed dad is disappointed once again. And my suspicion with this is like the fact that it uses crypto is just sort of, that's the easiest thing to build with.
I was going to say, it's just the mechanism for it.
So 5 years ago, it would have been, you're building on Synapse or something,
Sure.
Which is probably not a good omen for some of the crypto stuff. But I do think there's a maturity in the stablecoin ecosystem that is trying to do things that is very different to this. And yet I can't help but think, look, we're talking about it like it works. But it works because art points at something ugly. And let's stop building ugly things in our mainstream products. And maybe somebody doesn't need to do this.
Well, I totally agree. And I think like it is a good sort of send up of just sort of like this corner of this like culture. But I think, and the reason I wanted to talk about it just briefly is I do think that there are like institutions that sort of end up being like the school you go to learn how to do something, right? And, that changes over time, right? Like we used to have apprenticeships. That used to be a thing that you did, right? And
I did an apprenticeship.
Right. There you go. See, I did too. Yeah. So like, you used to do an apprenticeship, and the focus of like an apprenticeship was like learning the craft of something that's going to take a long time. And I can tell you, like, being an apprentice in the early days, it sucks, because all you do is spend your time sort of toiling in obscurity. You have no one is watching. There's no like audience. It's not in any way performative. There's no like real quick feedback loops. It's just like slogging away at like, carrying this over here. I remember early in my internship that I got when I was 16, spending like a long time shredding paper. Just like the most like menial, start at the very bottom and work your way up. But I do think that there's a benefit to like learning a craft and appreciating every part of it over a slow period of time. And when I see stuff like this, the thing that makes me think in a broader picture is we've sort of changed the environment in which people learn how to build things or learn sort of craftsmanship. And it is online to a real fault. It's very performative. It very much is like designed as much to provoke a reaction it is to think about like solving actual problems. And, the people who build stuff like this, like they're going to grow out of it and they're going to grow into trying to build more like normal stuff that people need in the real world. But I do wonder about the training that we're giving to like people who develop software, people who play with AI tools. Like if this is where you learn the basics of what you're doing, how does that shape the long-term culture of what gets built? And that's, to me, the broader question I wrestle with things like this. It's kind of funny just on a micro level, but on a broader level, it's like, what are we sort of incentivizing and what are we teaching people as it relates to like building products and being thoughtful about what you put out into the world? And that would be my sort of disappointed dad take. I really am turning into my father. This is interesting. But I think that's the kind of interesting thing. When I look at this, that's what I see.
Yeah, I think we can't help it. Look, I also think out of the soup crawls beautiful things. Life itself came from a soup of just like chemicals. And so you look at that and you're like, that's a bit weird. It's not very special. And then you see art and you see music and you see culture and you see beautiful things and you see nature and you see trees and birds and mountains. That starts in a soup. and it starts in violence and it starts in chaos. So I guess what drives me is this fundamental sense of optimism of like short term we can be in something ugly, but there are also craftspeople out there. I describe fintech brain food as a love letter to the craftspeople, the people who are working extremely hard. I speak to people at most of the fintech companies, and I almost got out of my chair and cheered when I saw Cash App's latest product releases and the amount of things they'd built, because I've been on the inside of companies like that, and I know how hard it is to build, and I know how hard it is to do that at velocity with the consumer segments they have. And so let's shine a light on the craftsmen and the craftspeople and the builders that are trying to do this right. And I think there's a lot of them out there, and person works hard and does something beautiful that isn't seen is not always given the credit. And also, like, when we get rage baited by this thing over here, we've got to remember that people are doing the other things. And I wonder if they can find a way to almost go into this contrarian counterculture that's coming out of Generation Alpha in particular. Gen Alpha wants to be offline. Not having a mobile phone is a status symbol. Owning vinyl is a status symbol. Like IRL is a status symbol. People want events. They want to be in San Diego in November. Like they want these things. And can the builders of places like Cash App and Venmos and anybody that's doing anything inclusive around the world whose names I didn't mention right now, can you guys play into that trend to catch the next wave of consumers and be the most successful companies? One of my content kind of inspiration for a long time was actually Mr. Beast. Not because he does like crazy flashy things, but because he gets the most attention for doing things that are at worst entertaining and at best socially good. And okay, you could argue that's not always been the case lately, and there are other things you can throw it in. But like, could we make the best business outcome be the best social outcome? It's harder, but I think it's possible. And I think it just requires those craftspeople to really drive at it. And for us to culturally celebrate that thing much, much more. And if we culturally celebrate that thing much more, we'll create that outcome a lot more. Because the financial nihilism came from the game is rigged. I think the financial hope comes from the fact that we can take control of this game. We have agency. Heck, if you can vibe code a dashboard for anything you want in 30 minutes, like, you can do stuff, people. You can just do things.
Simon, this has gotten like deeply philosophical and cultural and inspiring. I totally agree with everything you said. And I think, remembering that we have agency in all of this is so incredibly important. And I will end by saying that when I was at FinTech Exchange, my favorite thing I got to do by far, not that being on stage with you wasn't awesome, it was, that you'd be second on this list, but my favorite thing was I got about 25, 30 minutes to talk to the FinTech Club at the University of Utah, which is a group of students that are participating in the FinTech program. The University of Utah is launching a FinTech Master's program. So there's this like FinTech Club of students, and obviously they're college students. And I got to tell you, like, they were awesome. They were totally tuned into everything that you're talking about. They were, quite frankly, disgusted by some of the bad things that we've been talking about over the course of this conversation. And they were very intentional about, like, how do I find other people who want to build stuff that will make all of this better, and like turning some of these bad trends good. And I left that conversation feeling very hopeful about the future and very inspired. So I share your sense of optimism, and maybe just as a general sense, that's what we can try to manifest more of as we head into the rest of 2026.
You want to be hopeful about the future, go spend time with young people who are building things and learning. It does that for you, man. It does. It'll make a difference. Alex Johnson, thank you for sort of manifesting a cultural change with me, I guess.
Yeah, that was fun. With a little more kind of big picture, big brain than we normally do, but I think it is really, really the right time to do it, and you're the right person to do it with. So, Simon, thank you. It was a delight to see you in person. It's a delight to have you in my time zone. We will do this again soon, and I'm sure I'll see you back out on the road again.
Look after yourself, my friend.
All right, appreciate you. Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.